Hello, Accounting 201 students. Our final PowerPoint for Chapter 4, Accrual Accounting Concepts. In this PowerPoint, we're going to explain the purpose of closing entries and describe the required steps in the accounting cycle. In previous chapters, you learned that revenue and expenses and the dividends account are subdivisions of retained earnings, which is reported in the stockholders' equity section of the balance sheet. Because revenues, expenses, and dividends relate to only a given accounting period, they are considered temporary accounts. These right here, all revenue accounts, all expense accounts, and dividends are temporary accounts. In contrast, all balance sheet accounts are considered permanent accounts because their balances are carried forward into future accounting periods. At the end of the accounting period, companies transfer the temporary account balances to the permanent stockholders' equity account, retained earnings, through the preparation of closing entries. Closing entries transfer net income or net loss and dividends to retained earnings so the balance in retained earnings agrees with the retained earnings statement. Prior to the closing entries, the balance in retained earnings will be its beginning end of the period balance. For Sierra, this is 0 because it is Sierra's first month of operations. In addition to updating retained earnings to its correct ending balance, closing entries produce a 0 balance in each temporary account. As a result, these accounts are ready to accumulate data about revenues, expenses, and dividends that occur in the next accounting period. Permanent accounts are not closed. When we talk about closing the account, we are making them 0. Revenue accounts will then have a 0 balance. Expense accounts, 0 balance. When companies prepare closing entries, they could close each income statement account directly to retained earnings. However, to do so would result in excessive detail in the retained earnings account. Accordingly, companies close the revenue and expense accounts to another temporary account, income summary, which is right here. And they transfer only the resulting net income or net loss from this account to retained earnings. While it still takes the average large company 7 days to close, some companies, such as Cisco, employ technology that allows them to do a so-called virtual close, almost instantaneously anytime during the year. Besides dramatically reducing the cost of closing, virtual close provides companies with accurate data for decision-making whenever they desire it. So the 4 steps for the 4 closing entries are: you close revenue first into income summary, expense accounts into income summary into retained earnings, and dividends into retained earnings. Here's an example of the closing entries journalized. Write closing entries at the top. Revenue is a credit balance, so it is debited. Income summary is credited. Expenses have debit balances, so they will be credited with income summary a debit. Income summary, we had a net income. If you subtract this number from this, then you will have a credit balance, so we have to debit income summary, credit retained earnings, and the last thing we do is to close dividends, debit retained earnings, and credit dividends. This is an example of your closing entries in posting form with your T accounts. The first one is service revenue. It had a credit balance of $10,600, so you debit it and credit income summary. The next entry was to close your expense accounts. All of them have debit balances, so you will credit them with 1 entry in income summary for the total amount. You find your balance. 10,600 minus 7,740 gives you 2,860. So you're going to close income summary, you debit 2,860, credit retained earnings, And then the last one you close is your dividends account. Again, the order: revenues closed first, then expenses, then income summary, then dividends. After a company journalizes and posts all closing entries, it prepares another trial balance called a post-closing trial balance from the ledger. A post-closing trial balance is a list of all permanent accounts and their balances after closing entries are journalized and posted. The purpose of this trial balance is to prove the equality of the permanent account balances that the company carries forward into the next accounting period. Since all temporary accounts will have zero balances, the post-closing trial balance will contain only permanent balance sheet accounts. This is a visual of the summary of the accounting cycle. Number 1, you analyze business transactions, then we journalize, we post to the ledger accounts, we prepare a trial balance, journalize and post adjusting entries, deferrals and accruals, prepare adjusted trial balance, prepare financial statements, journalize and post closing entries, and prepare a post-closing trial balance. Now, I don't know that you need to memorize these steps. What I'd like for you to do is to think about what must be done in order to capture the financial transactions and make sure the transactions are ultimately reported in the financial statements. So if you just think through the process of what we've done in class, you should be able to come up with the accounting cycle. The assignments to complete are problem 4.7b, problem 4.8a, and problem 4.8b. Excel files have been uploaded, so you can use those if you would like to complete them. I will also have an example of the posting process in a problem. See you in Chapter 5.